Now, we did want to talk about the currency. The rupee tumbled for the second straight session to hit a fresh closing low of 68.95. A strengthening dollar, rising crude prices continue to put pressure on the Indian currency. And of course, this talk of a trade war kicking off today is not going to help in any fashion. Is there more pain in store? Let's ask Anant Narayan, of money market veteran and professor at SP Jain Institute of Management and Research. Anant, good morning. Thanks very much for taking our call this morning. Where does this go from here? Because the bad news doesn't seem to stop.
Morning, Menaka. Absolutely. Look, there is a problem on the external front. We have a precarious balance. Our current account deficit for this fiscal year will likely be the worst it's been in the last 6 years, at about $70 billion. Our FDI will not cover that permanent outflow, which means we need to borrow money just to make the balance meet. We've already seen the RBI intervene regularly to stop these flows, the negative flows. In fact, the permanent flows will be about $3 billion of outflow every month. To add to our problems, rather than flows coming in to bridge the gap, we actually are seeing reversals of, hitherto put on carry positions. So FPI in debt has been moving out. As of, net exporter selling is also going up. So all put together, not looking great. I think the good news for the rupee, one, of course, is that RBI still has plenty of reserves. They've probably sold about $25 billion since April, but they still have about $400 billion of reserves left. And the chances are that the government, particularly in an election year, will not want to see the rupee depreciate too much and too rapidly. So they're still holding on to their guns. And secondly, the weakening rupee probably might improve the current account over the course of the year. Exports should do better, not just because of rupee, but also because of the GST impact fading away and the demonetization impact fading away. And maybe we start to import and splurge less on smartphones from China with the rupee kind of weakening. But nevertheless, the problems remain. And frankly, rupee is still overvalued in real effective exchange rate terms by about 15%. Maybe we should just let the rupee relax a little bit more so that the balance becomes a lot more sustainable.
That seems to be the view coming in from the government as well, Anant, because I think in the last week or so, we've now heard Rajiv Kumar as well as, I think yesterday, Arvind Subramaniam speaking to one of the newspapers suggesting that a depreciating rupee is really not a cause of concern. And in fact, further depreciation would also not be a cause of concern. How are you interpreting what they'll say combined with RBI action, which I know is more to smooth out volatility than to defend it necessarily a floor? But at what point do you see them wanting to defend a floor of any sort? And let me add into that, there are estimates of the rupee moving all the way to 70 or 72. Do you think those are realistic in any fashion?
Well, on the government front, Menaka, I must admit that I'm kind of confused. While Niti Aayog and Arvind Subramaniam, the outgoing CA, did talk about allowing the rupee to weaken, we've also heard the finance minister Piyush Goyal talk about no real he's a rupee bull. I don't think he wants the rupee to weaken. And more importantly, realpolitik dictates that in an election year, a headline of rupee weakness in a country which unfortunately associates the strength of the rupee with economic prowess, plus the fact that it will immediately impact our petrol and diesel prices in the petrol pump, will likely make the government not want the rupee to depreciate too much, notwithstanding what Mr. Rajiv Kumar said. So I still think that the pressure on the RBI from North Block or from Delhi as a whole would be to try and keep a lid on rupee depreciation, which is kind of sad. While we have these sensational headlines about 70 and 72 or whatever, frankly, rupee at 70 is still overvalued. At 69 we are 15% overvalued. At 70 we would be about 12.5 or 13% overvalued. So, it's given the fact that the world has moved on and we have a differential growth where India grows faster, has a higher inflation than the rest of the world. And more importantly, given our balance has moved against us, we're clearly having trouble with our exports. We're clearly importing too much. And our FDI is not growing fast enough to keep up pace with this deteriorating trade balance. It's a natural adjustment mechanism to allow things to fall into balance. It's not a question of national pride or just looking at dollar rupee in isolation. Sure. This is a simple economic balance. So, if left to me, I think dollar rupee should be at 71, 72, and it's not a cause of alarm. It's not a runaway, fall by any means. It's an adjustment process which hopefully allows us to build a more sustainable external balance. Unfortunately, I don't think the powers that be will want that to happen very rapidly.
Can you connect the dots for me, Anant, since you understand this better than I do, in terms of what impact does it have on the local macro, right? For instance, we are now seeing, we just heard of the MSP increases, and I know that they were largely in line with what the expectations were. But I think inflation forecasts are now rising. There is the question of RBI maybe doing, 2 more rate hikes, possibly, based on which brokerage you follow, at least one in the second half of this year. It does seem that all of this could potentially impinge on growth. And like you said, we're a major importing country. So all of this is going to feed into inflation in one way or another, given where crude prices are. So what does this mean for growth? How are we to understand whether, if we were to let the rupee go to about 70 or 72, which you think is, where it would be fairly valued, what impact would it have on the macro then?
First off, Menaka, you're giving me too much of credit. I don't think I understand this better than you.
A little bit better than me, for sure. So,
look, I'll put it this way. There are imbalances, right? So we talked about the external imbalance. I think there's also a growing internal imbalance. While the overall fiscal deficit might not be worrisome, I think the quality of the fiscal deficit is not looking great. Even last year, we saw the revenue deficit move up quite sharply, from 1.9% to 2.6%. Whereas our actual capital spend came down in rupee terms, and not just a degrowth. It was a degrowth. It wasn't just a reduction in growth. And that trend, unfortunately, continues even into this year, where we are going to see more spending on MSPs. We're going to see probably subsidies for fuel going up, and we'll probably sell family silver more to fund for these current expenses. So the quality of the fisc isn't looking great. Our banking system isn't looking great, and we're kind of kicking the can down the road as of now, at least on the banking issues. And overall global context with Mr. Trump tweeting something or the other every day isn't looking great either. So put all this together, the macros aren't looking great at all for the country. In fact, they're worse off than they were a year back. That doesn't mean that the micros will look bad. In fact, normally when you have a fiscal blowout of some kind, blowout is the wrong word, when you have fiscal expansion happening, it's normally good in the short run for the micro companies. Look at MSPs, for instance. I'm sure a lot of companies will expect higher rural, spending to happen and therefore improve their bottom line. So in a funny way, you could have worsening macros coexist with improving micros for a while. But in the long run, the macros do matter a lot more. And I think, unfortunately, as things stand right now, we are in a situation of imbalance, which has to correct somewhere. We do need the external balance to correct. We do need the quality of our fisc to improve. And we do need to solve our banking problems and then pray hard that the rest of the world kind of falls in place as well. On the rupee valuation, just on last bit, it's not a question of where the rupee is rightly valued. I mean, who knows that? I mean, valuation is a different exercise altogether. It's a question of at what value does the balance look a lot more sustainable. It's not about saying this is where it should be. And at current levels, clearly we are borrowing short-term money to pay for our oil, for our gold, and for our smartphones. That's not a sustainable balance. You can't borrow fickle money to pay for short-term expenses. That's not how a household runs. That's not how a country should run either.
Fair enough. Do you expect the RBI to see it exactly the same way? So we should not expect any aggressive intervention, even if we were to move all the way to 70?
Look, RBI has intervened already. I reckon they've intervened about $25 billion since April of this fiscal year. Now, obviously, RBI has its own thinking, and they don't have a explicit rupee policy besides the vague statement that they don't look at levels and they only target volatility and some unstated measure of volatility.
Right.
But it is fair to assume that Delhi would want at some stage rupee to not weaken too much, and it's a fair point. I mean, let's be real. There's realpolitik involved as well. You don't want headlines on the rupee hitting you during an election year. So that might be weighing down on the whole ecosystem as well. But left to itself, I think RBI would be very, very concerned about the financial stability situation. Make no mistake, this is not a dire situation. I mean, we still have plenty of reserves. We're still a country with awesome growth prospects for the future. But as a central banker, as a conservative central banker, they have to prepare for the worst. and they would be looking at the financial stability and saying this is not the time to be lax, to be complacent. And so, yes, I think monetary policy will have that pressure of being more conservative than complacent and being preemptive. They will not want to fall behind the curve in the current context.
Fair enough. And who knows if this trade war gets converted into a currency war, given what we've seen happen with the renminbi over the last several weeks, and how several countries are looking at defending their positions in all of this. We're in for an interesting 6 months. Anand, thanks so much for joining us early this morning, talking us through where the rupee is headed from here on.